In this video, I'm going to break down some of the best option trading strategies for trading in a down market. The secret here is that real pro traders are making a killing in markets like this. At the end of the day, volatility equals money, and you want to learn how to take advantage of it. So let's dive in. So first thing, you have to calculate the expected move. The expected move tells us what the option market is pricing in terms of how big a move out to whatever expiration date you want. So we've got Boeing on the screen here. So let's take a look at Boeing going out to the July 15th expiration here. So what we want to do is take a look at where is the stock trading. Right now you can see stock is trading at approximately 132. So we want to isolate in on the 132 calls and the 132 puts. And if we add those together, and that's commonly known as the straddle, we can see that it's about $14.30. Again, what I'm doing is adding together the at-the-money call option and the at-the-money put option. That gives us a really good approximation of how much the option market at this point, right here, right now, is pricing in that Boeing will move by July 15th in either direction. Okay, so with Boeing trading around 132, if we take our 132 plus or minus approximately $14, just rounding off here, that gives us an expected range in Boeing going out to July 15th of 118 to the downside up to 146. This will be our money range. This is what we want to base our strikes that we're using. So if we're bearish, we target 118 to the downside. If we're bullish, we target 146 to the upside. But the reason we want to use this is the expected move is probable or calculated in with a 68% probability. Okay, so let's say we're bearish in Boeing, okay? Going out to July 15th, and again, remember, you can use any expiration you want. You can use a week, you can use 2 weeks, a month, 6 months, whatever it is, that expected move is going to reflect that time frame you're looking at. But right here, let's say you're bearish in Boeing, and we've just calculated the expected move with a target of 118 to the downside. So a super simple way to play that would be to just buy a bearish put spread in Boeing. And we can do that. Remember, we want to target 118. That is always going to be the target, or the end of the expected range is always going to be the option, the strike that we sell. Because if you think about it, when you sell an option, what do you want to happen to that? Well, you want to be able to receive and collect and keep all of that premium. So we want that credit that we receive for that option to theoretically get as close to zero as possible. So with 118 as the target, now you can see here in Boeing, there are no 118 strikes at July expiration. We've got to choose either between the 120 or the 115. Okay, so I'm going to choose right here the 120 strike. Remember, that expected move takes us down to 118. Higher probability that it's going to hit 120 rather than 118. So that's where we start. That's going to be the option that we sell. Okay? Now, to create that bearish put spread here for a potential move to the downside, we need to look at buying a put strike higher than 120. And the way that we do that is all based on reward to risk. All based on reward to risk. So if I were to buy, let's say, the 125 put here, okay, and you can see on the screen here, I've now put this on the screen, the 125, 120 put spread, okay, and that would cost us probably about $1.35. Okay, now is that good, bad, or indifferent? Right? Because just because we've identified a certain setup, a certain spread here, doesn't mean we automatically do it. Because every trade you make, every trade, no matter what the strategy is, has some level of risk to it, right? Now, we need to get paid the appropriate reward for the risk we're taking. So how do we calculate that here? In this instance right here, how do we calculate that? Well, the maximum value this spread could ever be worth is the difference between the two strikes. So 125 to 120, the maximum value, even if the stock went to zero, is $5. Okay? So if I invest or if I pay $1.35 for something that can potentially be worth $5, we need to calculate my reward to risk. Okay? So remember, $5 max, $1.35 investment, okay, means that our reward could be $365. 5 minus 135 is 365. So from there, we calculate our reward to risk. So the reward being 365, the risk, no matter what happens here, that's the beauty of using a spread like this, even if it goes the wrong way, okay? Even if we're wrong in our analysis, the most we could lose is $1.35. Okay, so we base our reward to risk off of the maximum exposure we have. If we take 365 divided by 135, okay, that gives us somewhere between a 2.7 and 2.8 to 1 reward to risk ratio. In fact, I'm going to get my calculator out right now and just do that right here. I'm going to take 365 divided by 135, and it's 2.7. Okay? Now, is that good or bad or indifferent? We obviously want to try and get as high of reward to risk as we can, right? We want to get paid as much as we possibly can for the risk that we're taking, right? Think about it as getting the most bang for your buck, right? The biggest bang for your dollar, okay? Typically, and I will tell you, this is from my 30 plus years of experience doing this, typically on just a spread like this, a vertical spread like this, whether it's a call spread or put spread, we want to get somewhere about 2.5 to 1 or higher reward to risk. Okay, well, this happens to be 2.7 to 1. Okay, so I like this. Now, does this mean that this would be the absolute end-all, be-all trade that I would make? Maybe, maybe not. This would be one of the simplest setups that gives you the appropriate reward to risk that you need to be looking for based on the expected move. All right, so in addition to using the expected move, everybody, we have to understand implied volatility. We have to trade not just directionally, we have to trade based on implied volatility. What does that mean? Implied volatility, yeah, it can be, scary word. Maybe some people don't understand it. But what it tells us is how cheap or how expensive an option is based on the premium amount or the extrinsic value amount that's priced in to an option. When volatility, implied volatility is low, options are cheaper. When implied volatility rises, they get more expensive. So in that Boeing example here, let's take a look at the implied volatility chart. So this is not a stock chart you're looking at now. This is an implied volatility chart. And you can see in Boeing here, it's just been gradually going up and up and up and up and up. But what happens mathematically with implied volatility, okay, is it's mean reverting. Meaning that when it's up here, it is going to come down and find its average or mean area. When it's down here, same thing. It is going to rise up to this area. So we need to be able to take advantage of buying and selling options at the appropriate time. Again, don't confuse volatility with direction, okay? Think of volatility, again, as either how cheap or how expensive an option is. And in these market conditions, okay, we're going to see volatility pretty extended. We're going to see volatility at these higher ranges here. So don't be afraid. Don't be afraid to sell volatility to sell expensive premium. Okay, we always do it as a spread so we know what our maximum risk is, but don't be afraid to sell that because it will normalize. All right, again, if you want to take a deeper look into implied volatility and dive into those charts even more, you can click the link right here and look at the video that I prepared on that. Thanks everyone. Remember to like, comment, and subscribe, and I'll see you on the next video.